2022 has not been a good year for the stock market. The S&P 500 is really close to being down 20% off its all-time high, which means bear market and recession territory. Hang out with me for the next 3 minutes and I'll explain how we got here, what's going to happen next, and most important, what do we do with our money now? So the real reason the stock market crashed in 2020 is because not enough people smashed the subscribe button. Just kidding. But you should subscribe because I will teach you how to turn market panic into profit. Thank you so much. Now let's begin. The actual real reason the stock market is tanking this year is because the Federal Reserve is tightening monetary policy. In other words, interest rates are rising. And when interest rates go up, the stock market becomes less attractive relative to other investments such as bonds, real estate, or even cash. To better understand how we got to this point, let's rewind back to March 2020 when COVID-19 shook the world. With the economy literally shut down, the Federal Reserve had to take massive action to keep credit and lending flowing through the financial system. So interest rates were slashed to zero to encourage business and consumers to borrow, lend, and spend. The Fed also launched a massive bond buying program to keep long-term interest rates down to further boost economic activity like home buying and mortgage lending. To sum it up, the financial floodgates were open to ward off the very real threat of a depression. It worked, and the good news was reflected in the stock market as investors, both big and small, went on a frenzied buying of everything from index funds to meme stocks. And why not? Interest rates were at zero, so there was no alternative for people to grow their money. If you timed it right, you could seemingly get rich overnight in GameStop, AMC, or Cathie Wood's ARK ETFs. Disruptive tech-heavy stocks that were normally seen as risky were going to the moon, and the broader market was making incredible gains as well. And for this video to make incredible gains, all you need to do is light up that like button now. The good times continued all the way through 2021, with the S&P 500 returning 18% in 2020 and another 28% in 2021. There were unintended consequences during the epic 2-year run of easy money though. Supply chain bottlenecks due to constant COVID shutdowns, combined with insatiable consumer spending, threw the balance of supply and demand completely out of sync. Because suppliers couldn't keep up with the demands of the buyers, inflation grew to the highest level since the early 1980s. Which brings us to today, where the Federal Reserve has to fight a different battle: inflation. That's why they're raising interest rates aggressively. It's because they're intentionally trying to slow down credit, lending, and spending in order to get prices back into balance. This has the opposite effect on the stock market than what we saw in 2020. That's why you're seeing all the hype stocks, Cathie Wood's ARK ETFs, all that high-flying tech stuff crashing hard. And that's why the broader market is coming down also. Investors have other options this year, and so money is flowing out of the market and into other assets. So what's going to happen next? We can look to history to see that this cycle has played out before, and this time is no different. As recent as 2018, the Fed raised interest rates until a tipping point where the financial markets couldn't handle it anymore, and then they had to reverse course to find that balance. And until now, inflation hasn't been a real threat since the 1980s. So I'm optimistic that with the Fed tightening, plus life returning to a more pre-COVID normal, that prices will come back down to earth. The Fed's top priority is to bring inflation back down to normal levels so we can expect interest rates to continue to increase, which will bring short-term stock market pain. However, this is normal. It's a part of the typical stock market cycle, so these events are more the rule and less the exception. So what do we do with our money now? Buy the index fund in regular monthly increments, as automatic and methodical as you can. Two big advantages here. Number one, you're not letting fear drive bad decisions, such as pulling your money out. The fact of the matter is that people are terrible market timers, and if you pull your money out, you're going to miss the bottom, and therefore the biggest opportunity for gains. Number two, you're getting great value. By buying when the market is down, it's like walking into your favorite store and getting 20% off. And if you look at the chart and zoom out, you'll notice that throughout history, the stock market always comes back to reach a new all-time high, if you have the patience to stick out the hard times. Listen guys, I'm losing money too. I'm not immune to this, and I just want you to know that I'm right there with you. But the more you know about why this is happening and that this is part of a normal cycle, the better equipped you'll be able to make the right decisions. If I did that for you, then again, please tap on that like button. And as always, I want to help you guys out as much as I can. So here's my 5 easy investing rules. It's a completely free guide that I use before making any investment decision. Link in the show notes. Make sure you get your copy. And if you do decide to opt in, you'll be automatically subscribed to my weekly newsletter where I'll send you my top dividend stock pick of the week. I analyze thousands of stocks to find the one that not only is going to pay you a great dividend, but I also make sure that the dividend is safe and the company is rock solid. And I'll do this for you every single week, absolutely free, no strings attached. Now watch my next video and I'll see you there.